We're here from Shaw & Sons. My name is Joe. I'm wealth management with Shaw & Sons, and I'm here with Sagar Shah, the CPA for the firm.
My name is Sagar Shah. I'm the CPA and the founding member, as well as the managing partner at Shaw & Sons. Today we're going to talk about a couple things, and one thing in particular that I see in almost every client meeting, especially with small business owners, even non-small business owners, W-2 people. Question that comes about all the time, which is, can I deduct my home office? Can I take expenses from this? And back in the day, this was allowable for everybody, pre-2017, before the Tax Cuts and Jobs Act. Whether you're on W-2, whether you have small business, a side gig, you almost always were allowed to take employee-related expenses as well as home office expenses. That's gone away since 2017. Now, the current tax law, which is getting voted on as of the date of this video, would keep those expenses out for people who don't own their own business. Now, if the current law expires, the new laws are not voted on, then yes, this would apply to even if you didn't have your own business and you worked on W-2, you'd be able to take these expenses. Assuming you are eligible for these expenses, meaning you have a side business or your own separate business that you run, whether or not it's an LLC or it's an S Corp or just in your personal name. The first thing that needs to go into mind here is regular and exclusive use of the home office. It can't be your kitchen table. It can't be your bedroom. It has to be a separate portion of the home, and you use it regularly for business.
Let's say you had a bedroom that you weren't using as a bedroom. You put a desk in there. As long as you regularly use that room specifically, that would be the home office.
Well, yeah, and using it as the bedroom is the key component of this, right?
Right. If you're sleeping there and you're working out of there, it's not going to count.
Then it's not an office. It's a bedroom that you use for work. If you don't have a bed in there, you only have a desk and you have a TV and you have some chairs for when clients come to see you, then it's an office, right?
So, I mean, off hip, how does the IRS know that? They're not gonna come to your house and be like, there's a bed in here, you're getting all this off. It's more of like a general rule, do the right thing.
It's up to you to prove it. Okay. Right? So in the future, if you were to ever get an audit and you took this position, it's your responsibility to prove
that it is an office.
The IRS assumes you're lying and that you're not using it for the space. To take pictures, keep documentation, and that's it. That should cover your bases.
I got you. Okay, cool.
All right? The other critical component to this is it has to be a primary place of business. Not sole, not exclusive, but a primary place of business. So somewhere that you would be able to demonstrate you do conduct business out of regularly. If you're a software programmer, you're coding out of this place in addition to your normal office. If you are a car salesman, you're doing your back office work out of this place. You show that, hey, these are the things that I finished there. You gotta keep track of records and proof of this in case the IRS comes and asks you in the future. But once again, this is for yourself to cover yourself, not because you need to do this in order to take the deduction. We talked about the types of people this qualifies for: businesses, side gigs. We talked about the things that you need to be able to prove: regular office, principal place of business, exclusively for office use, this part of the home. The question then is, how do you actually start calculating this stuff, right? There's three methods. You got the first one, which is simplified method. No thinking, super straightforward. Calculate the square feet of the office. Maximum number of square feet you can use is 300 square feet. Multiply it by 5. That's how much you can take for the year. So 300 being the max, 5 being the total amount of deduction. Maximum deduction you can use in the simplified method is $1,500. Obviously, we're trying to get more than that. That's not what we're trying to do here. So we want to use either option 2 or option 3. Option 2 is the actual expense method. So you take a calculation, and we're going to demonstrate this later with a whiteboard of an example from a client that had a similar question as to how much they could take. Generally speaking, what you're doing is you're taking the percentage of the house that's an office and multiplying it by the following expenses: your rent or mortgage, total, not the interest, not just the principal, the entire mortgage, your utilities, insurance for homeowners insurance or renters insurance, any repairs or maintenance that happens within the office space, which we'll get into as well, and then depreciation on the entire property if you are owning the property.
So what's like a reasonable percentage that you can deduct? Let's say your mortgage is $5,000, your utilities for the electric are $300 or $400 a month. Like, how do you know how much you should be taking from that?
Yeah, I will. So that's the great part, is you don't have to calculate any of that thinking. You're just taking the flat percentage, right?
Okay.
If you have a 100 square foot office and your whole apartment or house is 1,000 square feet,
You're taking the equivalent.
you're taking 10%. You're taking 10% of your utilities, you're taking 10% of your rent, you're taking 10% of your insurance, you're taking 100% of the repairs if it's specifically for the office, which we'll get into. And now remember, you can use one of the two. So if you do all these calculations and your actual expenses are only $500,
Right. Then
you can use the simplified
first
and take the $1,500. But generally speaking, when you calculate people's rents, especially, you're gonna get a lot more benefit from the actual expense method.
So let's say, because you have to be a business owner, right, in
Yeah.
order to be able to take the deduction. So let's say people watching, like, your home and you refurbish furniture in this room of yours that you have aside. Like, what would it need to be in order for you to say, this is a job that I can write this home office in,
Yeah.
right?
What Joe's trying to do here is find the loophole on
I'm
what's
always
a
trying
job.
to find a way to save as much money as possible. So if you sell beads, right, how many beads do I need to sell in order to write this room off in taxes, right?
So generally speaking, there's a rule with the IRS that qualifies hobby losses.
Okay.
So if the IRS determines after 3 years of consecutive losses in your business that you are not really a business, but you're a hobby, then you can't take any more losses. Right?
Okay.
So sniff test kind of makes sense here,
Yeah.
right? Like, Amazon doesn't show profits. Does that mean Amazon's not a business? No. I think there's things like that factor into this. But
Okay.
if in your example, you're selling beads
Right.
and you have one customer and it's your daughter,
Right.
you're
Right.
probably
Doesn't
not a
count.
business.
Okay, got it.
All right. So if it's a business, it's a business. If it's not a business and it's a hobby, it's going to be disallowed. And there's gray area there, and you should talk to your tax professional
Right.
about that gray area.
Gotcha.
So what are common expenses, right? We kind of went through some of them. There was one I touched on that allows you to take 100%. Everything else was percentages, right? And if you picked up on it, that was the repairs and the maintenance. Also, the furniture and the fixtures of that office space. So when it comes to a specific space, when you're working in a specific area, there are deductions that you're allowed to take there that are related to the upkeep of that office space. So how do we use that to save as much money as possible in taxes? Let's say you're building your house and you're building a brand new piece of construction from scratch. What would you do there? I would tell you to go and get a separate invoice for the space that you're building for your office, the flooring, the drywall, the carpeting, the paint, anything else you're doing in that space, and all of that would be considered construction costs, repair and maintenance costs. All of that is 100% deductible against your business, regardless of the square footage of your home or the square footage of your office compared to the home. That's probably the best and smartest way to write off a lot of expenses. I've had clients who have had their entire basement converted, redone, and they redid it as an office, and it was considered a tax deduction. I've had clients that have looked for apartments in Manhattan, and they were looking for apartments with 2 bedrooms, so that one of the bedrooms, sometimes the bigger bedroom, would be specifically used for an office space for their business, and it would be considered a deductible expense against their income. Knowing the rule allows you to figure out how to structure everything else around the rule, and that's something you should keep in mind. I touched on a third way to calculate. The third way to calculate is the number of rooms method. This is not one that people will advertise as much. People don't talk about it as much. But the number of rooms method, the way that works is like it sounds. You count the number of rooms in your house. If the office is one of the rooms and there's 10 rooms in your whole house and you have one room that's an office, that's 10%. There's reasons that you may want to use it. I suggest reaching out to us if there's questions about what's the best method for you. But we want to give you all the tools that you can to calculate it on your own, use all 3 methods, and come up with what's the best deduction for you. And we're actually going to run through that in a second. Before we get to that, a couple other small things, little loopholes that you might want to think about.
Yeah.
And how to take deductions, all right? There's a rule that says if you have a mortgage that's more than $750,000, and we got to fact check that. That might have went up, but I believe it's $750,000 as of last reading, and it stays at $750,000 for the new proposed tax laws. what do you do if you're a business owner and you're itemizing your deductions? Do you take all of that interest through your personal, or do you take it through your business? These are things you want to weigh out. Certainly, if your mortgage is over $750,000, not all of your interest is deductible. That's where this becomes very powerful, because now you're moving a percentage that's non-deductible on your personal returns normally to your business, and now you're able to take all of the interest deductions. Maximizing the direct expenses like those repairs, the maintenance, the furniture, the fixture, the things that go into your office, especially when you're moving into a new home and building out a space from scratch. Moving expenses are no longer deductible. However, if you have a home office, the portion of moving your home office from your old home to your new home can be deductible. And that can also be a portion of your moving expenses can be taken as a deduction off of your income. I think a couple things that we want to take is just like red flags that you want to be aware of. Number one red flag is not keeping proper track of the total expenses, because once again, this is your responsibility to keep this stuff, and you have to keep this data for 7 years per IRS regulations. So when you're writing off your utilities expense and your insurance expense, you want to keep track of that information and keep copies of that information for at least 7 years.
So you mean like keep the bills from your utilities for 7 years?
Technically, yes.
Okay.
Now, I've seen situations where the IRS is understanding and they will accept your payment. So if you have you write a check for your PSE&G, they will more often than not allow
Accept
you to,
that.
they will accept that.
Well, don't they usually audit 1 year, or they could audit the whole business and say, I want to see?
Typically, they audit 4 years.
Okay, 4 years.
So they'll audit 4 years, and then they'll pick 1 year out of the 4 as their sample year.
Okay.
And whatever the number they come up with, they multiply it over 4.
Oh, wow. Okay.
That's typically how they do it. I think another important thing to keep in mind here is you should have a lease between your business and the home office. Now, you may want to calculate all these things first and come up with a number. You may want to have CAM charges that you build in, where you charge a little extra for some of these other ancillary expenses. But generally speaking, it's good practice to keep a lease between the business as well as the home office.
For the house.
For the house.
So is that like you could chat GPT a lease?
You can chat GPT a lease, yeah.
And then just put something together, so at least you have something documented.
Yeah, I mean,
here's the lease to myself.
You're leasing
if I'm
from
the business owner.
yourself, so you probably can get away with that.
Right. But at least it's a document.
least
Most
it's
people
something.
wouldn't even have it.
Exactly.
Right? So you have something.
don't
You're already a step ahead.
Correct. A very interesting loophole, which is the separate structure. So if you're renting your garage, you don't have to do all these calculations. You can come up with the amount you want to rent for your garage out of your business and pay yourself
So
as an expense.
what's the reasonable amount we could do on that? Are you going square foot again, or are you going?
So we still got to keep some of these other things in mind, right? It has to still be a real business, especially if you're owning it. There's related party rules.
Okay.
Right? You're still picking up the income. You're taking expenses from one, picking up income in the other.
Right.
Maybe keep track of, you got to still do these calculations to see what's the optimal amount. Some of these other criteria, maybe you have a very expensive home and your depreciation is really high. Now you're able to depreciate a larger amount through the garage and the separate additional dwelling unit that you're using to take as a separate standalone structure for taking your rent expenses.
Gotcha. Okay.
Right? These are more little loopholes and things that you can put into play. There's a point about cars and whether or not parking would be considered deductible.
Okay.
Which I get that question all the time. It's not. Parking is not part of your home office expenses, even if you pay for a garage a crazy amount like they do up in
Oh, like
Manhattan.
you're saying if someone lives in the city and they're paying for parking.
Yeah.
They couldn't pay for parking as a business expense because they live there also.
Well, they couldn't take it as a home office expense.
Home office,
But
right.
if you're using the car for work, you should still
write
be
the
able
car
to
off.
take that expense.
Right.
Now, there's a specific rule that says you can't take expenses for parking where you live.
I got you.
So you can't rent your driveway to yourself.
Right.
You can't rent.
You can take a quarter of the corporate parking that's up the street in Manhattan and take that as a deduction.
Exactly.
Right. Because you're living there.
So technically, if you're parking in your garage at your apartment building, that's not going to be something that you can take as an expense from your business. So I think we should do a quick demonstration and a calculation and
Yeah.
see
Let's do
how see how this would work for a specific client who sent us some details here.
So now let's do a little bit of the math and then the explanation of how some of this stuff works, right? So to give me an example.
So we grabbed a case study from a client that's a new client.
Yeah.
Okay. And she is a graphic designer.
Yeah.
All right. She works from home. She doesn't have an office. She's a freelancer, her own business. Okay. Side business. So she makes income from other sources.
Okay.
But for this business, primarily working from home, she does not work from home for her other business.
Got it.
Okay. For her W-2 job.
Got it.
So here's some basic facts. The home square footage, 2,000 square feet.
2,000 square feet.
The office space,
Yeah.
300 square feet.
So we're gonna take 300.
Number of rooms in the house, 8. All right, she qualifies for the exclusive use. She qualifies for the regular use. And this is a room that is not used for anything other than office space.
Got it.
Here's some of the costs that she has. All right, she rents, she pays $2,000 a month, so $24,000 a year.
24,000 a year. Yeah.
She has about $4,800 a year of utilities expense.
So this is rent. 4,800 in utility. Okay.
$600 of renter's insurance.
Okay.
$1,000 of repairs and maintenance for the whole house. $500 just for the office.
So $500 just for the office.
See if Joe remembers what the 3 methods we talked about.
Simplified method, the basic method, and the rooms method.
Simplified method, the direct method,
And the rooms method. All right.
Correct.
The rooms
Let's
was
start with
the
the
other one that
simplified, right? Let's go with the easiest. Simplified is $5.
Oh, $5
times
up to 300
3.
square feet.
Correct.
So that's 1,500 total.
Yep. And
All
how
right.
many square feet does she use?
So there's 300. So that's the
she's
max you
maxed.
can use.
Correct.
All right. So we all know we're more than likely not going to use that one.
Yeah.
Because it's not as much money.
So method 1, $1,500.
So 1,500. If it was less than 300 square feet, it would be less than this. If
would be
was
less.
more, we're
would
stuck
still
at
be-
1,500.
Correct.
Got it. Okay.
All right,
That's
so
method
that's
one.
the easy one. Actual expenses.
Okay.
All right, so let's start calcing there. First step is you want to do what we talked about, which is the percentage of the
Yeah.
home office. So 300 square feet divided by 2,000 square feet.
It's 15.
Correct.
15%.
Look at that, 15%.
I'm pretty good. So 15%. So now 24,000. You got to help me with this.
15% of 24,000 is 3,600.
3,600. Okay. All right. 3,600.
All right, so 15% of 4,800.
Yeah.
The utilities is $720. And why don't you put times 15% on the top over all this? And then insurance, 600, 15% of that, $90. Repairs and maintenance, 15% of that. I think you could do that.
Yeah. 150. And then this is 75. Total.
Nope.
Not yet.
That's for the whole office. That's the one caveat. You can take that full $500 because that's specifically for the office.
Ah, okay. So this, you're actually getting the full
The full
500.
$500.
So
All right.
100%.
All of it comes out to $5,060.
So method 2, $5,060.
Correct. Now, the
room
number of rooms method.
Yep.
Number of rooms method would be the one room divided by 8. So we are at 12.5%.
Less than 15.
Less than 15.
Not even worth doing.
Not even worth doing because you're going to do all those same calculations at 12.5%, which is less than 15%. So you're not going to even look at number 3. The answer, the way that we're going to save this person the most money is number 2.
Okay.
So what does this actually
Yeah.
save you?
Let's say someone makes $100,000 a year.
Yeah.
And
Where do they
then-
live? What state? Pick a state.
Let's say New Jersey.
New Jersey. Okay.
So we're in what, 22% tax bracket?
18.
All right, so 18, and then we're
state?
paying state tax.
5.5.
Yeah, we're at 23.5%.
Yeah.
Right. So we get $5,060 in deductions.
Yep.
What is the actual tax benefit? What is the amount that we're not paying in taxes now that we have this deduction?
So you're going to save yourself $5,060. You multiply that by about 20, let's just say 25% between state, fed, NIIT. We're not talking self-employment taxes, which would be another 15% savings.
Okay.
All right. Let's assume this person is an S corporation.
Yeah.
Which is the best type of formation to be in many states, including New Jersey. So At 25%, they're saving around $1,015. So now, hypothetically, if this person had been doing this for, let's say, 20 years, and now this is where I can't do this type of stuff, this is Joe's specialty. We did $1,015 of tax savings every year for 20 years. And it was earning you, let's say, 7% a year.
I mean, 7% compounded over 20 years at $1,000. I mean, it'd be, well, 7% every 7 years. 1,015 in tax savings at 7%
20 years.
for 20 years. Compounded would be at 48,450.
So that's how much you end up.
That's how much more money you would have if you took this money and said every year, instead of me putting it into Starbucks or buying a new car or, you know, buying more stuff, I'm
Or
gonna
not
actually
taking the
save it.
deduction.
Right, or not taking a deduction at all.
Yeah.
Right, that's what you would have.